start off with a 40-minute or so presentation by Professor James Fischer from Southwestern Law School. He's going to be talking about just general parameters of both homeowners and renters insurance. At the conclusion, we will go into breakout rooms, and most of you have already been assigned to a breakout room with an attorney. Those of you who sent us your documents, letters, your policy, that information has been shared with the attorney that you were assigned to, or you will be assigned to. For those of you who haven't provided that to us, you should be able to share that with the attorney in the breakout room. Because of the large number of people who need help and signed up for this clinic, depending upon how many actually join us today, we may not be able to have everybody meet with an attorney today, but we'll know in about 10 or 15 minutes. We're limiting this to 30-minute sessions with the attorneys. At the end of the 30 minutes, we're going to ask you to exit the breakout room, and then we'll put in the next group of participants to meet with the attorneys. If you have immediate questions that come up during the presentation by Professor Fischer, you can put them in the chat, and if time permits, we will try to have the professor answer them. If not, hold them until you go to the breakout rooms. And so with that, I am going to turn it over to Professor Fischer.
Okay, good afternoon, everyone. Before we begin, I do want to express my sincere sympathy to each of you. I know you're here today because you suffered a devastating loss, your home, your memories, and your sense of security. And no words that I can share can fully capture what it means to go through something like this. Today's presentation is just not about policies and procedures relevant to insurance. It's about helping you understand your rights, navigate your insurance claim, and I hope begin the process of recovery. You've already endured more than anyone should have to. And my goal here is to give you some clear, practical information that gives you a measure of control over what it may feel like in your choices that you have to make going forward. You're not alone in this, and I want to thank you for being here. And I just hope my presentation and the follow-up sessions provide you with the tools, clarity, and support, and allow you to take the steps forward to rebuild your lives, your memories, and your homes. Okay? So just a little bit about myself. I've been teaching insurance law for, over 30 years now. Written a number of articles, co-authored a book. So I've been doing this for a long time. I've served as a expert witness in some major insurance coverage cases. So I do have some background in this, and I hope I'm going to be able to present it to you in a way that will be understanding and useful. So this is what we're going to cover today. What is insurance? How does it work? What is an insurance policy? How is it structured? And insurance myths, urban or otherwise. And it is going to be a little bit of a view from 10,000 feet to give you an understanding of generally what is going on, and I hope to better situate you if you do have a claim to be able to understand and work with a lawyer or a public adjuster as you choose in going forward if it comes to that. All right, so what is insurance? Insurance is really just a specialized form of contract, and you've all done contracts at one time or another, whether you've leased an apartment, bought a house, bought a car, leased a car. I mean, we enter into contracts all the time. Insurance is sort of specialized. You suffer a determined loss. you pay a premium. All right, and that's money out of your pocket that you give the insurance company. The insurance company, however, only assumes a risk of a potentially much larger loss, a covered claim. So both losses are fixed, your premium, and the policy limits for the insurance company, again, unless extended by the insurance policy. So how do insurance companies make money? Well, insurance companies pool similar risks. So I hope you can appreciate residences present certain types of risk, businesses, a different type of risk, industrial sites. So they pull them all together. And we're going to focus on residences because that's an obvious issue for us today. Homes, and homes can be low risk, high risk, uh, based on a variety of factors, where the home is, how it is constructed, so on and so forth. Apartments, different risk from homes. Condominiums, different risk from apartments. So insurance companies will group these all together, and they use a mathematical algorithm called the law of large numbers. Now, again, I'm not going to get into this at all, but I think it's helpful to at least understand how insurance operates. And so I used a common example. We all know that if you flip a coin, it's about a 50% chance that it'll be heads or a 50% chance that it'll be tails. But we all know that if we flip it 10 times, we may get 7 or 8 heads and only 2 or 3 tails. So what the law of large numbers tells us is the number of times we flip the coin. If we flip it 10,000 times, we get close to 50% heads and 50% tails. If we flip it 100,000 times, it becomes almost a near certainty that the number of heads will be essentially the same as the number of tails. Say 50,002 heads, 49,958 tails. And so what this allows insurance companies to do, and it's really very similar to what happens if you gamble in Las Vegas or an Indian casino. What we're really talking about here is the edge. The insurance companies are able to calculate to a high degree of certainty how many losses will occur within 1,000, 10,000, 100,000, or millions of policies, as long as those policies insure substantially similar types of losses. So again, we're focusing primarily on residencies here. If we can pool 1 million residences that are substantially similar, and again, as you note down there, the more homogeneous the risk pool, the more stable and the reliable the data becomes. The insurance company is able to look at that data and predict with a high degree of certainty what their loss exposure is. And again, to put it perhaps in a simpler context, it's really no different than what happens if you go to Las Vegas and play blackjack or baccarat or play slots, whatever your preference is. Built into that game is the house's edge. And the house's edge may be 2%, 5%, 10%. And what that means is over a period of time, let me use slot machines because that's the most beneficial for the house. The slot machines only were going to return 90 cents of every dollar you put in. That 10% is guaranteed to the house based upon the law of large numbers. You know, someone may hit a jackpot 2 or 3 times out of 1 or 2, 4 visits to Las Vegas. But over years, and all the other players who are playing those slot machines, the house will only pay out 90 cents on the dollar. So let me give you a little bit of an example here. So insurers calculate the risk of loss, as I've said, by using historical data, and then they hire actuaries to forecast future trends. And here's a prediction I put up. It's just totally a hypothetical number, but I hope it'll give you an idea of what we're looking at. So let's assume the risk of a fire loss is 1 in 1,000, and the average loss is $700,000. Again, these are always going to be based upon a range. And the insurer has 100,000 policies. The insurer will expect X dollars times 100,000 policy plus earned incomes on premium to be its income. So the X times 100,000 is the premium it's going to charge. The insurer expects 100 claims. If the insurer expects to pay 70 million in claims. So essentially what I've done is I've said, based upon historical data and forecasting future trends, the insurance company expects that it's going to have to pay 100 times 700,000 or $70 million. That's its underwriting loss exposure. It also has $10 million in administrative costs. So it basically is calculated, its break-even point is $80 million. So let's take the earned income out. That's something that would apply in real life. And I put it in here because it is a true factor. But let's just focus on premiums. If the insurance company only collected 80 million in premiums, it would break even. It would have no profit. If it collected 85 million in premiums, it would earn 6.2% profit. 90 million, 12.5%. So what you see here is really a policy that you as a policyholder would pay $800 for, $850 for, or $900 for. But if the insurance company is correct in its calculation, the insurance company would either break even, have a 6.2%, 6.25% profit, or a 12.5% profit on a $900 insurance policy. And I'm old enough to remember when you could get a homeowner's policy in Los Angeles for less than $900. Those were the days. So the law of large, I'm sorry, I went the wrong way. So let's look at what is an insurance policy. So I hope we kind of have an idea of how insurance companies make their determination as to how much they're going to charge and how much they expect to earn as profit. And again, these are not precise calculations. There's always going to be a little bit of leakage. The forecasting is never exact, but generally it's pretty good. So what is an insurance policy? You, the policyholder, are paying a premium, as I said before, that's a certain loss on your behalf. You write that check now for $4,000, $5,000, $8,000 to the insurance company. The insurance company's loss is conditional. The risk must occur. There must be a fire. There must be a water loss. There must be wind-blown damage, whatever is covered under the policy. You pay a premium, and the insurance company agrees to cover specific risks up to certain limits. All right, so it's not unlimited. It's either going to be the policy limits, unless the policy provides in certain circumstances that those limits may be extended. Again, and I'll talk about that in just a moment. All right, so what is a homeowner's policy and how does it differ from what most people are familiar with, which is an automobile policy? So I would suspect that most of you have never had a homeowner's claim before, but I would also suspect that many of you have had an auto insurance claim. So most auto policies are liability policies first and foremost. There's always a property damage side that the insurance company will fix your car, and that's analogous to a homeowner's policy. But most auto insurance policies are liability policies. And what I want to make sure that you understand, what really distinguishes them from homeowners policies is that when you are being sued because someone claims it was your fault that they were injured in an automobile accident, your interests and the insurer's interests are aligned. You both want to defeat the claim. And every dollar that you can settle that claim for less, it's in your interest and it's in the insurance interest to do that. And again, there are some exceptions, but they're not necessarily relevant here. First party insurance is a little different. You are the person who suffered the loss. And every dollar the insurance company pays you is one less dollar the insurance company has to pay other claims, administrative costs, or profits. So when it comes to homeowners insurance, your interest and the insurer's interests are not aligned in the same way they were with auto insurance. And so I put down at the bottom here, insurers are not your enemy, and I'm not trying to convey that by any stretch of the imagination, but they're not your friend. They have an interest in settling the case, in settling the claim for the least amount possible, and still discharging their duties within the boundaries of the law, not engaging in bad faith, which is the legal term that we use here. But they are not incentivized to pay you the most you would like to see on your claim. And in some cases, there's not a problem. The insurance company is willing to fix your property, restore your property. The result of the fact that the insurance company does not want to pay as much money as you think you deserve to restore yourself consistent with your interests under the policy. All right. So what's typically covered by a wildfire loss in California? So most insurance policies are standard form, at least to the extent they're issued by a private insurer. And so they cover your dwelling, which is your house. Other structures. So these other structures are all structures that are detached from your dwelling. So I have garage up here. If your garage is attached to your dwelling, it is part of your dwelling coverage. If you have a detached garage, for example, you access your garage through a driveway or an alley, that's going to be a detached structure. And that's going to be covered under your other structure coverage. If you have an accessory dwelling unit, that's basically a dwelling for family, in-laws, or rental. Again, if it's attached, it's part of your dwelling. If it's not attached, it's under your other structure. The reason why this is important is other structure coverage is usually a percentage of the coverage limits for your dwelling. And again, learning this after you've had a loss is never as helpful as knowing this when you negotiate the insurance policy with the broker, with the insurance company. But you may have a problem there if you have detached structures in getting full compensation because they're going to be subject to a different coverage limit. Personal property has a separate coverage limit. Loss of use is a separate coverage limit. Building code upgrades are critical, especially if you have an older house, as we'll see in just a moment. And let me just hold off on that until we get to that topic. And then debris removal. And then I put a note in here. I don't know if any of you are California Fair Plan policyholders, but the California Fair Plan is different. And I'll get to that later if time permits. So what are the key facts about insurance policies? Policies have coverage provisions and exclusions, exceptions. And again, it's changed a bit, but I think the old maxim is still true. What the big print giveth, the small print taketh away. So usually the coverage provisions are front and center, and that's half a page of the policy, maybe a page. And the next 15, 25 pages of the policy is the takeaways. So you have to understand that necessarily the insurance company is not covering you for everything that initially you would think you were being covered when you simply look at the coverage provision of the policy. Policies are complex legal documents. You cannot negotiate the terms of the policy, but you can purchase riders that provide additional coverage. And again, they may fit your situation or may not, depending upon how well advised you were by the insurance company or broker when you purchased your policy. Policies are not designed for consumers. Policies are legal documents that are designed to assist insurers when they wish to contest a claim. That's what your plaintiff's coverage counsel are going to tell you. And they are designed to make specific what is and what is not covered under the policy. And that's what the insurance company is going to tell you. It is important to understand that even though these policies are given pretty much on a take it or leave it basis, that the courts will generally recognize and enforce policy language based upon its plain terms. And the major exception here is that if the language is ambiguous, the court will interpret the policy language against the insurer and in favor of the policyholder. But here's the if in the brackets, and it's a big if the policyholder can provide a reasonable pro-coverage interpretation of the language. And that's something you're probably going to need a lawyer or a public counsel. I shouldn't say public counsel. That's something you're going to need a lawyer to do, because this would be legal advice and would be outside the range of what oops, sorry, going the wrong way, of what a public adjuster could do. So what are some myths about homeowners coverage? My policy covers, quote, all types of damage, close quote. Homeowners insurance are not all inclusive. It's not like you go down to Cabo and you're there for a week and everything is covered. Coverage exclusions, exceptions are many. Most of them are driven by whether or not the loss was caused by a covered cause or an excluded or non-covered cause. All right. So generally for a residential homeowner's policy or a renter's policy or a condominium policy, the policyholder must show that the loss was caused by a covered event if it's a homeowner, or if it's a rental policy, usually by a specified cause. That would not be a problem here for the most part. If your loss was due to fire, it may be a difficulty if you have a renter's policy if your loss was caused by smoke. So your garments, your furniture, your carpeting, everything was infused by smoke. The insurance company may take a position that this was not a covered loss under your personal property coverage because it was not caused by fire it was caused by smoke. And so that's always going to be a problem here. I gave a little example here. Let's assume the policy is damaged, the residence, I'm sorry, is damaged not by fire, but by rainwater runoff from a fire-denuded hillside after the fire. So the question is, what was the cause of the loss? Was the loss caused by fire, or was the loss caused by flood? Rainwater runoff would be within the typical flood exclusion in a homeowner's policy. And all I can tell you is here, the issue is going to be, what does the policy say? And how has the language been interpreted by courts? And that will be critical if and only if the insurer contests the claim. Sometimes they will contest it, other times they won't. It simply depends. But I would say if you fall into one of these situations, you're probably going to have to talk to one of the lawyers in the session afterwards. Myth 2, my policy covers my home's market value. Homeowner policies cover replacement costs, or what is known as actual cash value. Replacement cost is new for old, right? New for old. But here's where that comment I made earlier about building code upgrades, and down at the bottom there, you can see that little language on extended guaranteed replacement costs. Replacement cost is limited to replacing what you lost. So you had a 50-year-old house with 50-year-old roof, 50-year-old floors, 50-year-old lath and plaster pipes and everything else. You get a new roof, you get new pipes, you get new tile, right? But if the building codes have changed and you now have to do something to rebuild today that was not required when your house was originally built 50, 60, 80 years ago, that's not necessarily going to be factored into replacement costs. In that situation, you're going to have a building ordinance upgrade as part of your policy, or you're going to have extended or guaranteed replacement costs, which adds to the replacement costs. So if you have $800,000 of replacement costs, but to rebuild your house, to get all the permits, it's going to cost you $1.2 million. You're going to need something to bridge that gap. That 400,000 is not going to be picked up if all you have is replacement costs. You're going to need something more. Actual cash value is the depreciated value of your house. So actual cash value is not new for old. It's what is your house worth? And the way we look at it is, what was your house worth before it was damaged? What is it worth now? So if you suffered a partial loss, it would be the pre-damage market value of the house less the post-damage market value of your house. If your house was totally destroyed, so it has zero value, what you have to keep in mind, it's not the market value of my house. What could I sell it if I put it on the market? Because if I sell it and put it on the market, what I'm being paid for is not just the house, but also the land, the location, and everything else. So what the insurance company is going to say, the actual cash value is based upon the value of the residence or the detached structure, what actually was damaged or destroyed. And that's going to be a much smaller number than your market value, which you could have sold your house for before the fire loss. Myth 3, all my personal belongings are fully covered. Clothing and furniture are usually compensated at replacement. If you had old clothes, you get new clothes. If you had old furniture, you get new furniture. But it's like for like. And as I put here, if you have a Keurig coffee maker, you're not getting a Breville Oracle Touch Espresso machine as a replacement. You're going to get another Keurig coffee maker. It's just going to be a new one rather than the 10-year-old Keurig coffee maker you had that was melted in the fire. It is important to recognize that policies have limits for certain types of losses. So jewelry, cash, collectibles, stamps, coins, baseball cards. I had a cousin who, when I went over to his house, cousin-in-law, he had an enormous stamp collection. And he had books of stamps in a room in his house. And he told me at the time that his stamps, in his opinion, were worth about $100,000. I asked him if he had declared that with the insurance company, and he said no. And I said, you recognize that you're at risk if you have a fire loss. That stamp collection will not be compensated at its fair market value because you didn't declare it. So again, these are issues that you need to be cognizant of in terms of what you're likely going to get. I will receive enough insurance to rebuild. A lot of this, again, depends upon whether your policy has been updated. So what are your policy limits? Your policy limits should reflect current rebuilding costs. The problem you may encounter is when we have catastrophic fire losses, such as we suffered in Los Angeles this year, so many houses destroyed. There's only so many contractors. And when you get a situation where there are not enough contractors to do all the rebuilding repair work, what you normally can expect is costs are going to go up. So even though it may have been an accurate reflection of what your building costs were when you purchased your property, it may not accurately reflect what your building costs are today in the current rebuilding market. So again, a little bit about the California FAIR Plan. The California FAIR Plan is not as comprehensive as a private insurance policy. FAIR Plan covers primarily fire, smoke, explosion. You can purchase optional coverages, but I think what's more important to see is on the non-covered side. It doesn't cover water damage. It doesn't cover theft. Doesn't cover liability. It doesn't cover loss of use. It doesn't cover personal property off-site, and those are not optional purchases you can cover. And there are coverage limits in place. I think it's 1.5 million, but you can upgrade to 3 million for all covered losses, and that's everything. That's your dwelling, that's your structures, that's your personal property. So it's a much more limited policy. And I think, unfortunately, what some of you are going to face going forward is insurance companies not willing to write policies in fire-prone areas and finding yourself now forced to get coverage under the California FAIR Plan. So what can you do? You can get what is known as a difference in coverage plan, or DIC. And a difference in coverage plan is basically gap insurance. So it will provide more coverage for you than would be provided under the California FAIR Plan. Again, the downside of these policies is that they are primarily offered by what are known as surplus insurers. So surplus insurers are out-of-state insurers. They are not admitted to sell insurance in California, and they are only allowed to sell insurance in California when your insurance needs cannot be placed with an admitted licensed insurer. As a practical matter, there are brokers out there who will find these insurers for you, so that's not a problem. They do charge more. That's a problem. And they are not backed up by the California Guarantee Fund. So if the insurer does become insolvent, you can't look to the state to back you up. And so my recommendation here is, if you're looking at a surplus insurer, check a rating agency. AM Best is the best out there. And you want to find out what their rating is. And you should only get a surplus insurer who has either the highest or next highest AM Best rating. Some questions you might consider going forward. And again, I don't want to sell a tale of doom and gloom. Most insurance claims are resolved quickly and satisfactorily to the policyholder. Yeah. Should you use a public adjuster or a lawyer? Public adjusters cost less than lawyers. They don't charge as much, but they are more limited in the services they can provide. So a public adjuster can assist you in adjusting the property loss component of your claim, and that's it. They can't do any more. They cannot give you legal advice, or they should not be giving you legal advice. Only a lawyer can assist in litigating a claim and providing you with legal advice as to how you should proceed vis-a-vis the insurance company. There's a lot going on with a coverage claim. Again, I'm not trying to push you one way or another, but recognize that while lawyers cost more, they can do more. Public adjusters cost less, but there is less they can do. One thing that you might think about, in California, we have what is known as a limited representation. So a limited representation allows you to hire a lawyer for a very specific task. So you may be at loggerheads with the insurance company over a very specific point. And if you get that point resolved one way or the other, you're satisfied. So you may be able to hire a lawyer for a limited purpose to handle this specific issue. And the lawyer may be willing to do it on an hourly rate or a fixed fee rather than a contingency fee. And you might find that a better way to resolve your problem. So there's a range of options out there. And when you're considering hiring a lawyer, when you're considering hiring a public adjuster, keep in mind that it is a negotiation. And if you don't ask, you don't get. All right. Do I